Imagine a world where the prices of everything you need to survive are constantly on the rise. Your hard-earned money loses value every day and your dreams of financial stability seem impossible. This is the reality of inflation, and it's not just affecting your wallet, it's also impacting the economy in ways you may not realize. Are you tired of watching your money lose value as prices continue to rise? Inflation is the silent thief stealing your purchasing power and wealth. Most people don't understand this at all, but this phenomenon can have a significant impact on you, your environment, and also dramatic effects on the overall health of an economy. Hello 101 community, welcome back to our YouTube channel. In this video, we'll explore the concept of inflation and its effects on different sectors of the economy. You'll learn about the causes and consequences of inflation and get a better understanding of how it can impact your personal finances. And most importantly, you will learn how you benefit from it. But before we begin, if you're new here, make sure to subscribe to our channel and turn on notifications to never miss any updates. Now, let's start with the video. First things first, what is inflation? In simple terms, inflation refers to the general increase in the price of goods and services over time. When the cost of living goes up, it means that the same amount of money can buy you less than it could before. The concept of inflation has been around for centuries, and it has had a significant impact on economies and societies throughout history. In the past, countries would often experience hyperinflation, which refers to extremely high and accelerating inflation rates. One famous example of hyperinflation occurred in Germany in the 1920s, when the country was struggling to pay reparations after World War I. The value of the German mark plummeted, leading to widespread economic chaos. So, what can cause inflation? There are a number of factors that can contribute to inflation, including supply and demand, the cost of production, and government policies. For example, if there is high demand for a particular good or service, and the supply is limited, it can lead to an increase in prices. On the other hand, if the cost of production increases, it can also lead to higher prices for consumers. Government policies, such as taxes and regulations, can also impact the overall level of inflation in an economy. Now that you have knowledge about the basics of inflation, let's take a look at how inflation impacts different sectors of our economy. Inflation is often described as the silent thief because it can slowly erode the purchasing power of consumers over time. When prices rise, the same amount of money will buy less and less as time goes on. This is true regardless of the rate of inflation, whether it's 2% or 4%. It will still reduce purchasing power. And if inflation were to double, the overall price level would increase more than twice as much over the long run due to compounding. However, while inflation may be a burden for consumers, it can also bring potential benefits for investors. What effect does inflation have on investors? As far as investors are concerned, inflation is a mixed bag, but it can also present an opportunity to earn good profits. As prices rise, businesses may be able to increase their own prices and earn higher profits as a result. This can be good news for investors, as businesses may choose to distribute some of those profits among shareholders. So, if you're considering investing in stocks during a period of inflation, it's worth keeping in mind that businesses may have the opportunity to earn higher profits, which could translate into potential gains for shareholders. Inflation can create a tug-of-war between borrowers and lenders. On one hand, borrowers tend to come out ahead during times of inflation. This is because when they repay their loans, the real value of their repayments is lower due to the increase in price levels. In other words, they get to pay back cheap dollars with the dear dollars they received when they borrowed the money. On the other hand, things are not as positive for lenders, who may lose out during inflation because the real value of their money declines when they receive repayment of their debts. So while borrowers gain from the increased purchasing power of their money, lenders may see the value of their money decrease. Can inflation also affect salaried people and wage earners? People living on a fixed income tend to be more vulnerable to the negative effects of inflation. This is because the rate of increase in wages is often slower than the rate of increase in prices, which can lead to a drop in the real purchasing power of your money. However, people earning a flexible income are likely to benefit from inflation. If they are able to negotiate higher wages or increase their income in other ways, they may be able to keep up with the rising cost of goods and services and maintain their purchasing power. And this brings us to our next point, as most wage earners tend to be on the lower side of the socioeconomic spectrum. If you liked the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. You can also support the channel by visiting our merch shop and buy one of our products. The link is also in the description. Now, let's continue with the video. Inflation hurts the poor disproportionately. One of the biggest and saddest impacts of inflation is that lower-income consumers can be disproportionately affected by inflation. As they tend to spend a higher proportion of their income overall and on necessities, they have less of a buffer to protect against the loss of purchasing power that comes with inflation. This is why economists talk about a higher marginal propensity to consume among lower-income earners, while policymakers and financial markets often focus on core inflation, which excludes volatile items like food and energy. These are often a larger part of the budget for lower-income consumers. Not to mention, lower-income earners are less likely to own assets like real estate, which can act as an inflation hedge. When high feeds on itself. Inflation is a normal part of a healthy economy, but when it starts to accelerate and remain high, it can lead to rising expectations of future inflation. This can create a wage price spiral, where workers demand higher wages and employers pass on those costs through higher prices on their products. In extreme cases, this can lead to hyperinflation, where the value of money plummets and the cost of goods skyrockets. We've seen this happen in countries like Zimbabwe and Germany, where it took wheelbarrows full of currency or trillions of dollars to buy basic necessities. Also, when inflation starts to rise above the central bank's target, policymakers can raise the minimum interest rate to curb the supply of money and reduce borrowing costs across the economy. This tends to have a dampening effect on the economy, as people and businesses may be less likely to take on big purchases or projects if borrowing costs are high. On the other hand, higher interest rates can also be a reward for saving, as the risk-free rate of return on investments like treasury bonds tends to rise. The next impact of inflation that we are going to discuss is actually going to save you money, so sit tight. Inflation can lower debt service costs. Have you ever taken out a loan or mortgage and been worried about the impact of inflation on your payments? Well, it turns out that if you have a fixed-rate loan, inflation can actually work in your favor. When the value of money decreases due to inflation, the cost of repaying your loan with that inflated money also decreases. So even though you may be paying the same amount each month, the real value of those payments is actually lower. Meanwhile, the effects of having an adjustable rate loan such as a credit card or home equity line of credit can be quite the opposite, as your lender may increase the interest rate to keep up with inflation, which means you could end up paying more in the long run. It's important to carefully consider the type of loan that's right for you and how it may be affected by inflation. Inflation also increases the number of unemployed. You're probably thinking, what has one thing to do with the other? The trade-off between inflation and unemployment can be tricky, as accepting higher inflation in order to protect jobs may eventually lead to an inflationary spiral of rising prices and pay increases. This is what happened in the United States during the stagflation of the 1970s. In order to restore credibility and prove its commitment to controlling inflation, the Federal Reserve was forced to raise interest rates significantly and maintain them at a high level for an extended period of time. Unfortunately, this also led to a significant increase in unemployment, which lasted longer than it might have otherwise due to the Fed's earlier tolerance of high inflation. Inflation hurts bonds. Bonds are often seen as lower-risk investments that provide a steady stream of interest income at a fixed rate. However, inflation can erode the value of bonds by reducing the present value of this income. When interest rates increase in response to rising or high inflation, the yield on new bonds also increases. This can cause the market price of previously issued bonds with lower yields to drop, as bond prices are inversely related to bond yields. While investors holding a treasury bond will still receive the expected coupon payments and principal repayment at maturity, those who sell before maturity may get less due to the higher market yields. Although inflation might decrease the value of bonds, there are other investment options that benefit from inflation, and these are: as an inflation hedge, real estate has long been a reliable option for landlords. They can increase rents to protect themselves against the effects of inflation, which can erode the real cost of fixed-rate mortgages. It's worth noting that when commodity prices rise, inflation can often accelerate. However, commodities, particularly energy commodities, tend to continue performing well during inflationary periods. This is especially true for energy equities, real estate and investment trusts, and value stocks. In fact, these types of investments have a history of outperforming during times of high or rising inflation. Inflation can create losers, but also winners. For example, those who are able to earn profits may come out ahead during times of inflation. This could include business owners who are able to increase the prices of their products, speculators who benefit from rising prices for factors of production, and black marketeers who may see the price of their products rise over time. On the other hand, those who are living on fixed incomes or who are unable to increase their income may see their purchasing power decline as the cost of goods and services rises. It's important to be aware of how inflation may impact your financial situation and make plans accordingly. Thank you for watching our video on the impact of inflation on different sectors of the economy. We hope that this video has provided you with a better understanding of how inflation can affect different industries and how it can ultimately impact your personal finances. What do you think? Does inflation have an overall positive or negative impact on our economy? Please leave us a comment below. We love hearing new things from our viewers. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, don't forget to check the links in the video description. Remember, the global economy is upside down, and we have made it our personal goal to deliver financial education to everyone. Watch our video how you can profit in a recession appearing on the screen right now. See you there.